Hello and good day. Welcome back to our class. This is teacher Onedy Guzman and our topic for today is financial mixed ratio analysis. If we will recall the analysis of financial statements, we can have actually two things. We have the quantitative, meaning to say that is measurable. On the other one, qualitative, meaning to say observable. Under quantitative, we have traditional. It means we have vertical, horizontal, and the trend analysis. On the other hand, we will talk about the financial mix ratio, such as liquidity, solvency, and profitability ratios. For the convenience of our discussion, I write down here the financial mix ratios formula for liquidity, solvency, and profitability. So under liquidity, we have the current ratio, quick ratio, receivable turnover, inventory turnover, while for solvency, we have debt ratio, equity ratio, debt to equity ratio, and the TIE or time interest earned. Next, we have for profitability, we have the gross profit rate, then we have net profit margin, the return of investments. Ratio analysis helps to understand and monitor the entity's performance more closely and accurately. So the first one is liquidity ratio. Whenever we say liquidity ratio, it is the ability of liquid funds for the company to pay short-term and maturing obligations. For the convenience of our discussion, we will use the Great Merchandising Comprehensive Statement of Financial Position as of December 31, 2017 and 2018, as well as the Comparative Statement of Comprehensive Income of Great Merchandising as of December 31, 2017 and 2018. Let's start with the current ratio. It indicates the extent to which the current liabilities are covered by the current assets. So again, we will use the Great Merchandising Comparative Statement of Financial Position as of December 31, 2017 and 2018. So for our formula for the current ratio, this is equal to current assets divided by the current liabilities. So as of 2018, we have the current ratio is equal to 433,000 divided by 168,500. So this is the same as 2.57 is to 1. While for 2017, so the current ratio is equal to 393,500 divided by 147,000, which is the same as 2.68 is to 1. Let's move on to quick ratio or acid test ratio. It is more stringent measure of liquidity status of a business firm since some current assets are not included in the computation. So let's use again the Great Merchandising Comparative Statement of Financial Position. So again, if we will recall, quick assets is equal to cash plus marketable securities plus receivable. So if we will compute for the quick ratio, so this is quick assets divided by current liabilities. As of 2018, so we have 121,000 divided by 168,500. So this is equal to 0.72 is to 1. While for 2017 is equal to 148,000 divided by 147 or approximately 1 is to 1. So it means the quick ratio of the business has dropped from 2018 from 1 peso to 0.72 peso for every 1 peso of current liability. This trend is usually considered unfavorable. Similarly, it may be evaluated in line with industry standards in order to appreciate the significance of the indicator. The next one is the receivable turnover. It measures the velocity of conversion of trade receivables into cash during the year. So we will consider the following formula. So we have receivable turnover is equal to credit sales divided by the average trade receivable. So again, we will use the comparative statement of comprehensive income. So take note that average trade receivable is equal to receivable beginnings plus receivable end divided by 2. So that is why if we have for 2018, we have receivable turnover is equal to 1,635,000 divided by 113,500 plus 138,000 divided by 2. So this is the average. So it means we have 13 times. While for 2017, we have 1,457,500 divided by 138 only. So this is the same as 10.56 times. So it means that first, the quality of receivable may have improved, which means the goods credit policy may have been adopted. Second, the company may have instituted a better collection strategy or has selected a good collection agent. Next in line is the inventory turnover. It means that it measures the number of times inventories are acquired and sold during the year. So for our formula, we will use inventory turnover is equal to cost of goods sold divided by the average inventory. So that is why in 2018 we have 1,050,000 divided by the average of 302,000 and 238. So this is equal to 4.89 times. While for 2017, we have only 950,000 divided by 238. So it means we have 4 times. So the result of the computation may include the following. So inventory turnover in 2017 of 4 times may indicate better performance in the conversion of the inventory into cash compared to the operating performance in 2018 with 3.89 times. Also, it may appear that it takes basically 4 months for the business to convert inventories in cash in 2017 and more than 4 months in 2018. So the business may appear to be selling and buying goods that are not considered fast-moving items similar to the items sold in the supermarket. So the next type of ratios are solvency ratios. They are also known as stability ratios. So they are a group of financial ratios that measure the ability of a business to settle its financial obligation when they mature and to remain still financially stable. The first type of solvency ratio are what we call debt ratios. So they measure the proportion of funds provided by creditors on the total resources of the business. So let's move on to the formula for the debt ratio. So this is equal to total liabilities divided by the total assets. So as we can glean on the table, so for 2018, so this is equal to 668,500 divided by 2,433,000. So this is equal to 27.48%. On the other hand, on 2018, so this is 647,000. We have this data divided by 2,006,000. So this is 32.25% or 0.3225 is to 1. As we can say, of the total resources of the business in 2017, 32.25% had been provided by the creditors. This information may indicate that 67.75 of the total assets had been provided by the owners. The debt ratio in 2018 has improved to 27.48, This information may indicate the business does not rely heavily on funds provided by the creditors. And finally, in general, the debt ratio for the 2 years is considered highly favorable from the perspective of creditors because it does not reach the generally considered maximum level. Next one is the equity ratio. It determines the proportion of resources provided by the owner or owners of business. So again, for the formula that we will use is equity ratio is equal to total equity divided by the total assets. Again, this is our table that we will use. As of 2018, we have 1,764,000 divided by 2,433,000, or this is equal to 72.52%. While for 2017, we have 1,359,000 divided by 2,006,000, or this is equal to 67.75%. So it may appear in 2017 that the owner of the business provided 67.75% of the total resources used in the operation. This ratio may also suggest that the owner supplied 67.75 cents for every 1 peso on the total assets of the business, while the creditor provided 32.25 cents. The trend of the equity ratio improved in 2018 to 72.58%. It is clear indication that the business is not highly dependent on creditors' fund in financing its operation for the year 2017 and 2018. The equity ratio appears to be attractive to the eyes of the prospective creditors since more than 50% of the total resources have been provided by the owner. The next type of solvency ratio is debt to equity ratio. So it measures the proportions of debt and equity in the capital structure of the business. So for our formula that we will use, we have debt to equity is equal to total liabilities divided by the total equity. From our table, we have the following total assets, total liabilities, and the great capital as of 2018 and 2017. For 2018, we have 668,500, okay, which is approximately or equal to 37.89%. While as of 2017, so this is 647,000 divided by 1,359,000, or this is 47.61%. As we can see, the debt to equity ratio of 47.61 in 2017 in its simplest term may suggest that the creditors have provided 47.67 cents for every 1 peso supplied by the owner of the business. The debt to equity ratio of the business improved in 2018 to 37.89%. It may suggest that the owner has provided more funds to the business than what is provided by the creditor. Finally, the trend in the debt to equity ratio of the business may appear favorable in the eyes of the creditors since the business does not heavily depend on funds from the outside source in managing its operating activities. Next is the time interest earned. It measures the debt paying ability of the business. It reflects the degree of protection provided by the entity to its long-term creditors. The formula that we will use for the time interest earned is equal to interest before interest and taxes divided by interest expense. So again, this is our table that we will use based from comparative statement of comprehensive income as of 2017 and 2018. For 2018, we have 300,000 divided by 50,000, so this is equal to 6 times. While 2017, this is the same as 230,000 divided by 50,000. So we have 4.6 times. So the times interest earned in 2017 indicates that the operating income of the business before payment of interest can cover the interest expense for 4.6 times. The time interest earned ratio has improved in 2018 to 6 times. The income from the operation is sufficient enough to shoulder the cost of borrowing. And finally, a higher times interest earned ratio of the business appears to be favorable from the perspective of the creditors. The next group of ratios are profitability ratios. These ratios show the effectiveness of the business operation. The first of which is the gross profit rate. It measures the percentage of gross profits. So for the formula that we will use, we have the gross profit rate is equal to the gross profit all over net sales. Recall, we have the gross profit is actually sales minus the cost of sales. So that is why if we will get the gross profit as of 2018, so we have 1,635,000 minus 1,050,000 divided by 1,635,000. So we have the gross profit rate of 35.7%. On the other hand, in 2017, we have only a rate or gross profit rate of 34.82%. So what do we mean by this one? So if we will analyze that the cost of sales of the business is more or less 65% of the total sales. So the rate may appear to be high for the operations of the business. The gross profit rate in 2018 slightly improved against 2017 operations. The rate may indicate that in 2018, the business has 35.78% margin available to cover the operating expenses. Under a normal situation, it is favorable for the business to have higher gross profit rate. The next ratio is operating profit margin. It measures the percentage of profit available deducting the cost of sales and operating expenses from sales. So again, let's consider here operating profit margin. So this is equal to operating profit divided by sales. So again, so this is the table that we will use. So operating profit, this is equal to 300,000 divided by our sales, which is equal to 1,635,000. So we have operated profit margin as of 2018, which is the same as 18.35%. While for 2017, the operating profit margin, which is equal to 230,000 divided by 1,457,000, or this is 15.78%. So we can say that the operating profit rate improved in 2018 from 15.78 to 18.35%. Since the only figure between the gross profit and operating profit margin in the operating expenses, the increase in operating profit margin may indicate that the business has instituted some controls to effectively manage the incurrence of costs and expenses. Let's move on to the net profit margin. So it measures overall operating results of an entity. So for the net profit margin, the formula that we will use is net profit margin is equal to net income divided by the net sales. So again, so this is the basis for our computation. So if we will look for the net profit as of 2018, we have 175,000. So this is your income after tax divided by your net sales of 1,635,000. So you have net profit of 10.7%. On the other hand, for 2017, you have net profit margin of 126,000. So we have here income after tax divided by your total sales of 1,457,000, or you have net profit margin of 8.64%. So the result indicates the following. So the net profit margin of the business has provided positive contribution to the equity of the owner after the provisions for interest and taxes. Number two, the contribution of the business operating performance to the owner's equity has improved in 2018 at 10.7%, okay, from 8.64%. Finally, through the net profit margin contributed positively to the capital of the owner's equity, the level of the net profit margin should be compared with the industry average to determine whether such level of performance is at par with other businesses in the industry. The last type of profitability ratio is the return of investment. So it measures the amount of net income per peso of investment in a business. So there are two types of formula that we will use. So the first one is the ROI is equal to net income divided by the average total assets. However, if it is interest bearing, okay, return of investment. So we have net income plus the interest times 1 minus tax rate divided by the average total assets. So again, we will repair on this table. So again, so as of 2018, since this is tax-bearing interest, so we have net income plus interest times 1 minus tax rate divided by the average assets. So we have actually 175,000 pesos as our income after tax. Then our interest is actually 50,000 pesos times the rate of tax is 30%. So we come up with our ROI of 9.46 as of 2018. If we will compare this to 2017, so we have 126,000 as the net income, which is your income after tax, plus 50% still our interest expense, and our rate is 30%. So upon computing this, so we have the return of investment, which is 8.03%. So the return of the assets slightly increased from 8.03% in 2017 to 9.46% in 2018. This trend may indicate a favorable movement of the return on investments. In 2018, it appears that there was 9.46 cents return for every 1 peso invested on the asset of grade merchandising. However, in 2017 operations, the return was only 8.03 cents for every 1 peso investment on assets. To summarize our discussion on financial ratio, again, it is divided into three: liquidity, meaning to say the ability of the company to pay its short-term maturing obligations. While solvency is again also that is the ability of the company to pay the maturing obligation such that it is a long-term maturing obligations. On the other hand, profitability ratio discuss or it measures the effectiveness of business operations. Qualitative factors in the analysis of the financial statements. A sound financial statement analysis is not merely calculating but looking beyond the results of mathematical computations. The following factors are considered in making a financial analysis. The first one is the presence of one major customer. Is there a key customer that contributes significantly to the total revenues of the company? If there is, losing such customer may drastically reduce future income. Number two is the presence of one major product. If there's a single product where revenues heavily rely upon, if there is, the revenues may seriously affected when the demand of such product drops. Number three is the competitors in the market. Generally, few competitors are likely to give company a bigger share of the market. On the other hand, the presence of more competitors may force the company to lower its prices, resulting usually to lower profit if the sales volumes does not improve. Number four is the reliance on a single supplier. Does the company rely on a single supplier? If it does, it may experience decline in revenues when there are anticipated shortages of raw materials or merchandise. Finally, the goal of the company. The company may or may not be returning earnings to the shareholders because of expected future expansion that will be financed from internal source funds. So data derived from the financial statement analysis are not absolute measures of entities' operating performance. They are only indicators of liquidity, solvency, management efficiency, and profitability. Again, that ends our discussion. So this is Teacher Onin Guzman. Do not forget to subscribe to my channel so that you will be notified about my new videos. Thank you.